wealthbranch.com.
5 dividend stock traps and warnings. Warning number 1, an unusually high dividend yield. Stocks with dividend yields that sound too good to be true often are. Generally, yields of 13% or higher are potentially dividend traps. Companies with high dividend yields can be at risk for a dividend cut. They often announce dividend cuts during an earnings report. Here are 2 examples of the stock price plummeting after a dividend cut. From the time frame of October 2018 through December 2018, CBL Associates (CBL) stock price dropped over 40% from about $3.40 to approximately $1.90. During the October earnings call, they announced a dividend cut from 20 cents down to 7 cents a quarter. To add insult to injury, the dividend was later suspended altogether due to a lawsuit. The share price dropped to under $1. During the February 2019 earnings call, CenturyLink (CTL) announced a weak earnings report and a dividend cut from 54 cents down to 25 cents a share. The stock went from $14.50 to approximately $12.75, a drop of over 12% in one day. Warning number 2, poor management. During the first half of 2019, GameStop (GME) had an enticing dividend yield of 19%. After the sale of their Spring Mobile business for $700 million, they had over $1 billion to reward shareholders. During the June 2019 earnings call, the management decided to suspend the dividend altogether. After the elimination of dividend, shares of GameStop (GME) declined 27% in after-hours trading. Instead of rewarding shareholders, management decided to prolong their runway of million-dollar salaries and poor decisions. Warning number 3, downturns and dividend cutters. Do you know how your favorite dividend company will react during a recession? Research how management will respond to a downturn. Management will often use declines or soft earnings to cut dividends. During the 2008 recession, even companies with strong financials decided to cut the dividend. Warning number 4, a high dividend payout ratio. The dividend payout ratio is an indicator used to see if the company can afford to keep paying a dividend. Companies with a high dividend payout ratio are at risk for cutting the dividend. The dividend payout ratio equals total amount of dividend paid out divided by company net income. A payout ratio over 100% means the company is paying out more money to shareholders than it is earning. This may cause the company to lower or suspend dividends altogether. A conservative payout ratio is 40% or less. Some investors may choose to set their criteria at a 55% max payout ratio. Warning number 5, verify your dividend yields. The reported dividend yield can often be wrong. Make sure to verify the dividend yield. Here are some reasons why a dividend yield can be wrong. A recent change in dividend amount. An incorrect calculation based on monthly, quarterly, or annual dividends. The company stopped paying dividends a long time ago. A unique dividend payment throwing off the dividend yield.